What's up, guys? We're back with another long form Finance Friday. I wanted to try to hit the Silicon Valley Bank issue in a more succinct way than I did last week, especially now that the dust has settled a little bit. And you really have to go back to, on the heels of COVID when the Fed was printing money at a rapid clip. And as a result, the public markets absolutely ripped. And the tech sector in particular was the biggest beneficiary of this run up. And Silicon Valley Bank was the 300-pound banking gorilla in the tech sector. So late 20 and all of 21, money was flowing into Silicon Valley Bank in a meaningful way, and all of a sudden they're sitting on a mountain of deposits. Now, every bank, including Silicon Valley Bank, make money by taking deposits and either loaning it back out in the form of commercial loans or mortgages, or they invest in a portfolio of mostly fixed income securities, very safe securities. Don't be intimidated by the term fixed income security. If you had a mortgage on your home and you're paying interest only for 30 years, and at the end of that, you got to pay back the mortgage in full, that's a fixed income security as it relates to the bank, okay? Very predictable, very steady stream of cash flows. Now, this is the part of the story that you might be surprised by, which is Silicon Valley Bank wasn't taking a lot of these deposits and investing in risky bullshit. They do participate in what's called venture debt, and I'll touch on that in a different video, but that really wasn't the problem. It was a significant portion of their balance sheet was invested in both treasury securities, very safe, and more importantly, mortgage-backed securities where the average duration or the average payback of that portfolio was 6 to 10 years. So they did this and they were investing in these assets in 2020 and 21 when interest rates were close to zero. So what they did is they basically trapped a bunch of these deposits in mortgage-backed security portfolios at 1.5% very low yield for a long period of time, on average 10 years or so. And then to further complicate these matters, there's an accounting rule that says when you purchase these long-dated assets, if you have no interest in selling them, you can designate them as what's called held to maturity, meaning you're going to hold them until you get paid back, and therefore you don't have to mark to market the asset. You're not planning on selling it anyway, so why would I have to, mark down on my balance sheet what it might be otherwise worth if I had to sell it? Now, here's where the problem comes in. The Fed starts raising interest rates very quickly throughout 2022, and they were very open and transparent about this. And what's frustrating is one of the first lessons they teach you in finance, that is, as interest rates rise, bond prices fall. This is very fundamental, and everybody involved in this situation knows this lesson, and it's actually quite simple. There is a simple formula to explain that, but it's kind of far more fundamental in supply and demand. I mean, imagine you're SVB and you're sitting on a portfolio of 10-year bonds paying 1.5%. Fast forward to March of 2022, you can go get a 2-year treasury at 4.5%, and it's risk-free. Who in the world wants a 10-year bond only paying 1.5% when they can otherwise go get that? So there was no demand for 10-year paper yielding 1.5%. So what Silicon Valley Bank would have to do if they wanted to sell it, now remember they designated these not for sale or held to maturity. If they wanted to sell it, they would otherwise have to really discount the value of that bond to make up for the fact that you can go get a better interest rate somewhere else. And the markdown they would otherwise have to recognize if they sold the asset is the fundamental issue here. And they weren't required to mark to market, and therefore their balance sheet looked a lot better than it probably was in reality. Now, there's a lot of people to blame here. I don't believe the depositors, should be blamed really at all. I mean, the Fed could have easily regulated this and seen this coming. Silicon Valley Bank, officers had every opportunity to get out in front of this. But the depositors themselves, it's hard to place blame on them. And one thing I want you to realize is, take BPN as an example. We shopped for a line of credit recently, and I have 4 term sheets. I'll screenshot these covenants here. But every one of them required as a condition of the loan that we, BPN, keep 100% of our commercial deposits at the bank as a stipulation of the loan. This is a very, very common stipulation. So if you hear people blaming these companies for not diversifying their cash and deposits, I think that's a very unfair misrepresentation of what really happens. Not to mention, I've worked for many businesses where we are routinely paying out to vendors and paying out AP $500,000, $750,000, $1 million in a given week. That's a pretty routine thing. So there's just a practical reality to trying to spread your deposits into 10, 15 different banks. If $250,000 is the FDIC insured limits. So I think that's really kind of unfair to place a lot of blame on the depositors for not diversifying. And then lastly, this is far from a bailout. And certainly as it relates to backstopping the deposits, I think it's hard to call it a bailout. And what you have to understand is in the 1930s, the Fed established what's called the Deposit Insurance Fund. And they required any FDIC insured bank on a quarterly and regular basis to make recurring deposits into the Deposit Insurance Fund. In the event that a bank fails, they can tap this this Deposit Insurance Fund, and they can prop up or resolve the otherwise failing bank. And so that's the money they're using to backstop these deposits. They're using it exactly for its intended purpose. So that particular piece is not costing taxpayers any additional money. And I think that's an important thing to note here. Now, moreover, the equity holders, the owners in Silicon Valley Bank, they're wiped out, rightfully so. Any debt holders in Silicon Valley Bank, they're wiped out, rightfully so. A lot of the key officers are going to have a very difficult legal battle ahead, shareholder lawsuits, et cetera, rightfully so. So none of them are getting off scot-free. They have a lot to deal with in the wake of this. And so I'm not trying to necessarily pick one particular party to blame. I think there were a lot of things that failed here, and just wanted to do my part to try to distill some of the rumors and help you guys walk away from this video, take in other information, and form your own opinion on the matter. So that is a very long-winded Finance Friday.